Well, looking to make a fortune from investing, be it SIPs, mutual funds, or stocks, everyone wants in. But few truly understand the entire game. The biggest fear? What if I lose everything? The biggest myth? Only experts can make money in the market. Today, we cut through the noise and break it down for you with someone who knows the game better than the most. So, if you've ever wished for a simple, practical, and jargon free investment playbook, listen up. This conversation might change the way you actually think about money forever. And here is why you shouldn't scroll away and listen to the entire interaction. Because, ladies and gentlemen, we have with us Devina Mehra, a reckoning force in the investment world, a founder, chairperson, and managing director at First Global. A strong woman who doesn't shy away from being truthful, from being analytical to the policymakers. She's already broken barriers when she became one of the first few women to secure a trader's license from BSC at a time when even men struggled to get one. Well, she took an Indian investment firm global 25 years ago, long before anyone else could have even thought about it in India. Her expertise has been recognized by the Wall Street Journal, Financial Times, Forbes, Bloomberg, and Fortune, where she stood alongside Nirmala Sitharaman and Neeta Ambani on the 50th most powerful woman list in 2022. And today, she is here to discuss more from her book, Money, Myths and Mantras, the ultimate investment guide. Thank you so much, Devina ji, for joining us on CNN News 18 and taking out the time for this interaction.
Thank you for having me, and thank you for a very kind introduction.
Well, it was much needed with the kind of laurels that you've achieved in your life. But let's begin, and let's begin with getting the basics right. Devina ji, we've seen in flux over 10 million young investors joining the stock market. And middle income families are largely pinning now at this point of time in the market, they're pinning their hopes on making a fortune out of their investments, small, big, large investments. But what largely overwhelms this audience is the financial jargons. And at this time, when we see this influx of investors joining the market, understanding the basics of the market becomes even more crucial at this point of time. So your book begins with 4 thumb rules for financial health, right? Can you actually break down those for our audience in the simplest way possible?
Yeah, so first of all, markets are somewhere where you should look at for returns, but not to make a fortune, at least not a quick fortune. Yes, that is the caveat. And so be sensible about your investments. This is something I say that don't play fast and loose with your hard earned money. आपके खून पसीने की कमाई है, उसके ज़रा उसको सम्मान से देखिए. लक्ष्मी का सही में सम्मान वही होता है when you use your money carefully. So first point that I make is that the other option is that you freeze. You think that only when I understand everything will I even touch anything to do with investments. But what you need to do is to get your broad asset allocation. Right now, asset allocation sounds like a fancy word, but all it means is that the broad categories. So first of all, you look at where all you are invested today. All the money that you have, where is it? Is it in equity? How much is in equity? Equity means both direct stocks as well as equity mutual funds. How much is it? What we call fixed income. So fixed income is what? It is fixed deposits, it is things like your savings schemes, it is debt mutual funds, that's all fixed income. Then there is gold or silver for that matter. There is real estate, which may be the house you live in or something you have inherited from your parents or grandparents, one plot of land, whatever. So all of that, there might be other things like crypto. And on the other side, you will have loans against your home, against your car, any other loans.
Indeed.
So you first look at all that and you decide how much you want in each category. That's the most important decision, and that will determine 80-90% of your returns. I mean, sometimes people say that how can small investors do asset allocation? But now, since mutual funds are there and you can invest small amounts there, you can do asset allocation even if you don't have, 25 lakh rupees to start with. So, and sometimes people say that I'm earning so little, so where do I start? I cannot invest 20% of my salary. So I said invest 5%. and but make a promise to yourself that next year's increment I will invest 70%. That's the hard
Oh,
part.
yeah, that's really a hard part. Waiting for the increment throughout the year when you have already made plans of ये यहाँ खर्चेंगे, and then pushing your investment, your increment largely towards your
Yeah,
investment.
so that's asset allocation is the first one. I was talking about the four investment rules. So one is asset allocation, of course. The next is risk management. So I say investing is a loser's game. What does it mean? That you must play this game where your first objective should be not to lose big money. I mean, loss, not being a loser means doesn't mean that you will never lose money in equity markets, but you must limit those losses and make sure you don't take a big hit on your capital, because if you start with 100 rupees and if you are down, let us say, to 50 rupees, you have to double your money to come back to 100.
Right.
So be careful on that front. So do things like put a stop loss. I've explained how to put a trailing stop loss, and then also make sure you are not over invested in one or two industries, so diversify that. देन लुक एट योर ओवरऑल पोर्टफोलियो, बिकॉज होता ही है कि हम लोग बोलते हैं ऐसे इन्वेस्ट करेंगे वैसे इन्वेस्ट करेंगे, बट वॉट यू एंड अप डूइंग इज दैट यू हर्ड समथिंग ऑन टेलीविजन, you heard something on a telegram group, your friend told you something in a party, and you invest.
Yeah.
So you're not even looking at how your overall portfolio looks. So do the basics. And one other thing which I say is global diversification. And why do I say that? One, very simply, don't put all your eggs in one basket. And one statistic which I always give is that when I started working, the dollar was 12 rupees.
Indeed, yes.
So now there's a 90% depreciation in the course of less than a full career. So when you're talking of financial goals which are 10, 20, 30 years away, there's no way you can ignore the fact that the rupee depreciates.
Indeed.
And which means your portfolio value keeps shrinking in dollar terms. That's what a rupee depreciation means. So the only way to prevent that is to have a significant portion of your investments overseas, which Indians do too little of. Because earlier you could not do it, it was not allowed, but now the liberalized remittance scheme of RBI is very generous.
Right.
But people still don't think of investing abroad.
All right. This makes me come to a question from the newsroom. Now that we're talking about dollar and rupee comparison, the world is largely heading towards de-dollarization. How do you see that impacting the Indian market or the market overall?
See, first of all, I think this whole de-dollarization hawa was made out to be too big. And like 2 years ago, I did a video saying why this is not going to happen in a hurry, because the reserve currencies of the world don't change that much. And you cannot become, like, for example, you cannot say that rupee will become a significant currency, because who will buy rupees beyond the point that they want to import something from India? And so also for any other currency. Now things are with Trump Sarkar coming, things are in a bit of state of flux. So yes, I think the dollar has become suddenly less attractive than it used to be, and maybe now more reserves of central banks will be invested elsewhere, maybe a combination of things like Swiss franc, euro, Japanese yen, and so on. So yeah, little bit more of de-dollarization can happen. But I don't think that's going to have a direct impact on the Indian market per se.
All right. You just talked about Trump Sarkar. Do you think Trump Sarkar is actually killing the Indian economy with the tariffs also coming back to play? And how will that be impacting the market?
I don't think that that's going to be a direct impact on India to a very significant extent, because India is not a big exporter to start with. I mean, that's not our main business, and all this, a lot of it is saber rattling, in the sense he says something, then he rolls it back. For example, he's talked about tariffs on pharma. Now on one hand he talks about that how the purchasing power for the average American has come down. Now healthcare is already very expensive in the US, much more than in any other developed countries. And the outcomes are worse, in life expectancy, infant mortality, etc., they are worse. And Indian pharmaceutical exports are relatively less expensive. So it brings down the healthcare cost. If you increase tariffs, means you're further increasing healthcare cost. So I don't see that as a very serious threat. Other than that, IT services is one other area which I have been discussing with some of the IT companies. Also, they do not think that's going to be a serious threat. Again, they have fairly flexible models about where they deliver from. And the fact is, a lot of American companies have very large setups in India.
India, yes.
So, the tariffs, I don't think are going to be a very significant game changer for India either way.
All right. Now let's come back to the book and talk about the chapter where you're talking about asset allocation being a massive game changer. One of the biggest mistakes investors, big, small, young, anybody, makes is thinking that all their money should go into one place. Or probably, like we've discussed earlier also, hearing from the investment uncle in the neighborhood or coming from the fin influencers ka gyan, we tend to subject most of our investments in one basket. How does asset allocation change the investment game, and how risky can putting all of your investment in one basket can be?
So sometimes people ask me this that I'm young, I'm 25, I'm in a good job. Should I put 100% of my money in equity? And I always say that don't put 100% of your money in equity. Never put 100% of your money in equity, because equity money is essentially money you do not need for a minimum of 8 to 10 years, often more than that. And then because you should not need to touch it, because the predictability of equity returns is very low in the short term. So if
Okay.
I ask you in a year or two what will be the equity return, that can be all over the place. There have been long periods when equities have given no return. I mean, 94 to 2003, the net movement in Indian equity markets was a zero over 9 years, and
Over
then
9 years, yes.
and then after for the next 4 to 5 years, it went up 6 times. So equity returns can be that lumpy, and you might need money in the interim. You might lose your job, you might want to study abroad, there might be a medical emergency, you might want to buy a home. So have money in other categories, as I said, which includes things like fixed income, gold, and real estate you might have anyway. I mean, not necessarily, you may not have made a conscious investment decision, but you might have anyway. So have everything, but don't be on extreme ends of the risk spectrum. This is what I say, because if you put 100% in fixed deposits, it is very safe, but you will not even probably beat inflation. Whereas some people will say, I'm in fixed deposit, I've never invested in equity, but can I now give up my job and start trading in the market, or start doing FNO and derivatives, or crypto trading? So don't do what I would call stupid things like that. That's really, this is like playing with fire. So don't be on extreme ends, that don't be at zero risk, but don't be taking inordinate risks also. So come to a sensible asset allocation and keep to that. Don't keep fiddling with it again. Equities, people talk of 20-year and 30-year compounding, and yet you look at the data, the majority of the mutual fund holders do not even hold the scheme for 2 years. So you will not get the compounding if you just keep flitting in and out. So, you know, be sensible. As I say, good investing is often boring. It is not the sort of thing that will get you exciting party conversation.
Okay, this is a code. Good investment is always boring. All right, so this brings me now to a question that also was posed from the newsroom. Now that we were talking about equities at times might not be able to deliver the desirable goals, especially when in short terms. This is a question which is related to short term itself. 5 to 10 lakhs of budget I have, and I want to invest in a short term plan for my Europe trip to be encashed in a matter of 5 years. What should I do?
No, I mean, 5 years, again, you will have to do some kind of asset allocation. You cannot say, anyone who's telling you that you guaranteed get you this in 2 years or 3 years, that no one can do. So if people are telling you that, that's always a trap. That's how people get trapped in things like chit funds, for example, that double your money in X amount of time. And those are always Ponzi schemes, where in the first few people will even get that doubled money.
Indeed, and the rest start.
Yeah, because you are
falling
paying
apart.
the first guys out of the new money coming in. And at one point, that's a classic Ponzi scheme where you are running it and where you are paying the old investors out of the new investors' money, and if the new money stops coming in, that whole thing collapses.
Yeah.
So, be, as I said, be sensible with your money. I mean, don't go by. You can assume that any fin influencer who's talking is getting paid to say what they are saying. So, as they say, just show me the incentive and I'll tell you how that person will behave, because
Right.
that person's incentive is to tell you only good things. And it is not just the fin influencers, there's a whole lot of mis-selling in financial markets in general. You mentioned the insurance uncle. I mean, they have sold ULIPs, they've sold insurance as investment product. So have basic financial literacy, know how to calculate an internal rate of return, know how you can calculate return on any investments net of whatever you are paying as fees or commission and all that, and be able to at least make a sensible decision. I wish they were teaching this in school, that you're less likely to use advanced calculus. At least basic financial literacy should be taught: compounding, taxation, internal rate of return, all of these things.
Yeah, these are very must things to know, because we all tend to get this kind of basic financial knowledge and everything once we've started, started giving our first EMI, probably somewhere down the line in 2 years. We start building that corpus. This doesn't come as a pre-handed, setup of information that we can use. You have to struggle constantly. You have to, test, run, and then probably
And
take a risk.
that too, I mean, you don't know whether the information you are getting is
Yes, it's credible
unbiased
enough also or not.
and credible. So that's the problem, because in financial markets, there's always an incentive for people to sell you something that makes them money rather than what is the best thing for you. So you might get, I've heard of retirees going to the bank and their RM selling them, a relationship manager selling them an insurance product, which is
Indeed, that has
totally,
happened.
yeah, so which is totally unsuitable for them. And to an extent, I would even say mutual funds launch thematic schemes like whatever, small cap fund, defense fund, IT fund, PSU fund, according to whatever is running at that time. And usually that's towards the end of the theme. It's closer to the peak of the theme than the beginning.
Oh.
Because, yeah, because the logic is very
And
simple.
most of us tend to fall for that scheme
Yeah,
when it
because
comes to our investment
yeah, so
bankers advising us.
I'll tell you why. Because when that theme has done well for a while, that is when the person on the street comes to know about it. There's also a FOMO feeling that मेरे दोस्त ने डिफेंस में पैसा बना लिया, मैं छूट गया, तो now अब ये डिफेंस का फंड आ रहा है, let me put in money. That's the logic, and the fund also knows it well, that this is when the money will come in. So again, it is a good thing for the fund because the assets coming, they get the fees, but it is not a good thing for the person putting in the money. And many funds later on even say that we had only given a choice to you. It was your choice to invest in it. So, it's not nothing wrong with what we did.
That's quite a revelation, because in this setup, in today's era when trading world is also getting digitized and you have free access to invest through applications just a click away, these kind of things or notions or tricks and tips tend to get ruled out. Now that brings me to our next question: DIY investing, yes or no? Because in an era of where again digitization, trading apps, and finance YouTubers that are coming to play, many young investors, by just getting that influx of knowledge that is coming from the digital platforms, irrespective of the fact that it is credible enough or not, is it biased or not, without that second thought, many young investors want to do it themselves. So in your book, you're largely also talking about the risks of do it yourself investing. What should beginners keep in mind before taking that leap? One small piece of advice to them.
Yeah, so I always say that if you're deciding that you want to invest yourself, if you've been investing for any length of time, look at your own track record, not a filtered track record कि हाँ मैंने ये stock निकाला था वो 3 गुना हो गया. Look at everything you bought and what happened to it. And consider yourself also a fund manager, and then say that this is the track record of this fund manager I, and this is a track record of all the other fund managers that I am considering, whether in mutual fund or portfolio management scheme or whatever. So if rationally, how much should I allocate to this fund manager called I? And you will often find that your track record is definitely not the greatest in the world,
Yep.
and definitely does not merit 100% of your corpus. So you, most of the time, most people who are doing a job or business in their working hours do not have the time to do individual stock investing on their own. It is usually better to give it to a professional. And if you feel that I want to understand this, or otherwise I'll look like a fool in front of my friends and I'll have nothing to talk about at the next cocktail party, then put a small, which is essentially your play money, maybe 10-15% of your money, you say I'll invest myself. But most of your money, for most people, it is better to give to professionals.
Okay. Devina ji, help me understand with these large number of investors that have joined the market in the last 2 years, what we term as COVID investors, right? Young investors.
Now 5 years since COVID started.
Yeah. But the whole idea, and a lot of middle class families also these days are pinning their hopes in the market to make their other ends meet or probably build a fortune. How does this sentiment, what do you have to say about this sentiment? Is it scary?
Yeah, it is. I mean, as I said earlier also, that you can look at markets at giving you a certain return over a very long period of time, over the decades, but it is certainly not going to balance your household budget on a month to month or a year to year basis. But for markets, you need to have a really long horizon. Like there was this book on Rakesh Chunjunwala, and I think the authors also did not realize the importance of that line. And he says that I made my money in 1989 to 92, in 2003 to 2007. Look at the
Yeah,
difference in time.
yes.
And then 2009 to 11. In between, there were even 5 years where I made no money.
Right,
So
yes.
his superpower was understanding that equity returns are that lumpy. I gave that example that 9 years zero returns, and then in less than 5 years 6 times. So that's the nature of the market. So you cannot say that, oh, I mean, I will invest and I will get this kind of regular income from it, or that it will double my money in 2 years. That's where a lot of people were in much of 2024. I used to have people come and tell me that I don't have unrealistic expectations. I'll be happy with 35% compounding per year. I said that is an unrealistic expectation.
Indeed,
Because the
indeed.
markets don't give you that much. But when things are going very well, everybody thinks it's very easy. But that never sustains. And too much greed always comes to a bad end.
Indeed, that fairly said. But now that you've also touched on points of market tycoons like Rakesh Jhunjhunwala, we recently read somewhere in one of your columns that don't follow the footsteps of Warren Buffett or Rakesh Jhunjhunwala. What makes you say that?
Well, actually, there's a long chapter in the book with many points on this, but let me just touch on one or two. One is that they may not be doing what you think they are doing. So, for example, you mentioned Warren Buffett. People think that he buys and holds, that he never sells. Whereas the data shows he sells more than half of what he buys within 6 months and 85% within 2 years. So, he hardly buys and holds. That's one. The other part is the fundamental question is wrong. So you are saying that this person made a lot of money, and what is the strategy that they use, and that will get me that money. But no, the question you should ask is that of all the people who followed this strategy, what happened to them? So, for example, if you have a very high risk strategy where 90% of the people go bankrupt in a year, but the 10% make 10 times their money. Okay, so you start with 100 people, and at the end of 1 year, 90 people are out of the game. 10 people, now that 100 rupees has become 1000 for them. So you do 5 rounds of this. At the end of it, there'll be only one person left out of the 100, but they would have multiplied their money, thousands of times. And you will, if you start with that who made the most money, you would say that let me follow this strategy. But you forget that 99 people went out of business following that strategy. so so ask the right question. So I am a statistics graduate, so it is like it's, are you asking the right question?
Okay. Okay. Now, market myths are mostly busted, and you're trying to break it down in very simple words for our viewers. But your book is called Money, Myths, and Mantras for a reason, for sure, as far as I have read it. What is the most dangerous myth you've seen investors fall for?
There are many, I mean, actually. So we discussed some of these, that people think making money is that easy in the markets. As far as investing mantras, also a lot of things, that following successful investors is one. Another one says that invest in your circle of competence, which means that if you like the product of a company, buy the stock of that company. But that sort of simplistic thing, it's not that it never works. It has worked at certain periods in certain markets. The thing in markets is that themes change. No asset does well forever, no country, and no industry or sector. So there are times when consumer brands, for instance, will do well, and times when they will not. So someone has to
That has
understand
to.
that, and also global diversification is another thing which people don't think of. People think
Indeed.
India is growing so well, why do I need to look outside? So
Yeah, the
that's,
unspoken aspect of investment strategy. Could you please quickly elaborate on that? Like Indians love gold, real estate, and fixed deposit. Why is it critical for us to look beyond the borders when it comes to investments?
so even gold, why were हम लोग की दादी नानी क्यों सोना खरीदती थी? And
Aaj tak there is a lot of pressure for that.
they were sensible to buy gold, because at that time you could not invest overseas. So the only way to hedge the fact that the rupee kept depreciating was gold, because gold prices were set in dollars. So that is why a dollar chart of gold goes up and down like this. I mean, it's a very volatile asset. But the rupee chart looks very good because the rupee depreciates. So it's actually a rupee depreciation chart. So सोना हमारी दादी नानी ठीक खरीदती थी. They were the sensible people in the game.
So I
But
should also continue investing in
but
Sona.
now you have other avenues to invest globally. At that time, there was no other avenue. This was the only
Only
avenue.
avenue.
But now, as I said, the liberalized remittance scheme is very generous. So it is 250,000 per person per year, $250,000. So that means family of four can send out $1 million. That's almost 9 crore rupees every year. So that is much more than anybody ever needs. But our mindset is set from a time when it was not possible. Like even after I started working, let alone invest abroad, if you were traveling, most of your young audience will laugh at this, you could take out only $500 once in 3 years. And if you were traveling more than once in 3 years, you could only take out $20 each time. Can you imagine? And the laws were such, you were not supposed to borrow also from anyone. So you are going on a trip abroad with $20 where your credit card will also not work. So that is the India we grew up in. So it was never possible to invest abroad. Now it is possible, but the mindset has not changed.
Okay. Okay. And how has this investment journey been like for you? Because you have been a strong reckoning force as a woman also in your industry. How challenging it has been as a woman only to reach this kind of a level, go for global diversification also, and building a brand from from very scratch and making it go global at a time when even the men also couldn't think about it in India.
I never thought of myself as man or woman, gender. I mean, the work is gender agnostic. The only reason why when growing up or even after I started working, when I joined Citibank, I was the only woman in the entire investment bank across the country. But it never struck me because I thought, how does it matter? Now I only underline it because I think girls and young women do not have enough role models.
Indeed.
So that's the reason why I underline the woman part now. But as far as the work is concerned, yes, I mean, there is all levels of discrimination in terms of people not wanting you there, or for example, data all across the world shows that women get interrupted much more often when they are talking, right up to if you're a judge in the Supreme Court of America, where they've kept the data, it's the same. Even the female judge gets interrupted. But those things are ultimately minor things. As far as going global is concerned, I mean, there was no man or woman about it. Everybody just told me it can't be done, that you are a nobody. You cannot go to a large market and expect to be heard or people to take you seriously when they have the Merrills and the Morgans and the Goldman Sachs and the Citicorps. I said, let me see if I know how to analyze securities. And the gratifying part in all that was that I did not know anyone personally in the media, and yet just on the quality of our work, we were in Forbes, Fortune, Business Week, Wall Street Journal, front page, Barron's, everywhere in no time. So it's just the quality of the work. And for me, it's been a passion. I say in this business, the input and output is money. But for me, The real thrill is in the learning. So that is, and that is what I've tried to communicate through this book also, that what I have learned, I'm sort of trying to teach, because my parents were both, have been both academics, and so that teaching genes are strong.
Yeah,
So,
pretty much
so
strong,
learning
yes.
and teaching is very central to what I do. And learn from, be curious about the world, learn from first principles. That's,
Well, that has been an incredible journey. Before we wrap it up for you, one last question: the secret sauce to multi-baggers. Everyone dreams of investing in the blue chip stocks, the next Tata, Tesla, or TCS. What is the real secret in finding and holding on to such kind of stocks?
anyone who tells you they have this magic wand, jadoo ki chhadi or crystal ball, is misleading you. It's as simple as that, because in the history of the world, there has been no investor, no fund manager who, let alone have a 100% multi-baggers, has had even 50% of their portfolio as multi-baggers. That person does not exist. Warren Buffett says in 70 years of investing, there have been only 10 or 12 of my decisions that have accounted for all my returns. And no one knows at the beginning which 10 those would be.
Indeed.
So, what you have to
Oh,
do at the minimum is have a portfolio of 25, 30 stocks chosen with some system. I'm not saying random 20 stocks. But even then, you should tell yourself that out of those 30, a good number will be duds. At least 5, 7 will be complete duds. A few will give you normal returns. And then, if you have chosen well and your luck favors you, you might get a couple of multi baggers. But you will not know in the beginning which are going
which
to
are
be
the
the.
multi-baggers? Right. Okay. One quick question from the digital world before we head towards the game. All right. A common thing about the market cycles that I have also searched, and a lot of people have ended up asking in most of your previous interviews as well: will the stock market crash again in India? People often go to Google to get this. So we saw the COVID crash, and now people worry about another downturn. How should investors approach market volatility, and should they be really concerned about time and again of market crash?
See, first of all, this is the nature of markets. That if you look at 18, 20 years, every year there has been at least a 10% fall from the top, barring 3 or 4 years. And one of those 3, 4 year exceptions was 2023. So after 2 years, you had this kind of market correction, downturn, whatever. Of course, the average stock is down much more than the index is down, which is why the pain appears so much more. So, but as far as the large cap stocks are concerned, while there might be some downside left, I think the risk now is more that you will miss out on the upside than that you will come down.
Down.
Because in 40 years, if you miss out on the 10 best days of the market, you give up two-thirds of your return. So right now it's a time to be invested, only with one caveat: it may not be the same stocks or strategies where you are currently invested. So sometimes something might have, some stock you bought from 100, it is now 60 or 50. It might still be a sell. So don't think that once it goes back to 100 is when I will sell,
I would
because the
say.
market has no interest in what price you bought it at, and many stocks will never recover.
Okay.
That is again the nature of the market, that stocks that go up in one bull run may
May
not be
not
the
be recovered.
stocks that go up in another bull run. And it does not matter where you make up the money. It does not have to be from the same stock or the same mutual fund scheme.
All right. Okay, Devina ji, before we let you go, let's play a quick rapid fire round called Truth or Myth. So I'll be throwing some common investment beliefs that also we reached out to a couple of people in the newsroom, and we had some polls pushed out on social media platforms. So let's begin. The first one is you'll have to quickly pick and choose, okay? Buying blue chip stocks is always safe. Truth or myth?
Myth. The
Investing in
definition of blue chip changes.
Okay. Okay. Duly noted. Investing in IPOs is a guaranteed way to make money.
Absolutely not.
Myth.
Yes.
Okay. Timing the market is better than time in the market.
No.
No?
Myth.
Myth. Okay. Stock tips from friends and WhatsApp groups can really make you rich.
Hardly ever. You are playing lottery.
What do you have to say about sugar coatery analysts that go on air every morning on TV channels?
I think you should not spend your time watching business TV all day. It's a waste of time.
And what do you have to say about the YouTubers who are now, giving all sorts of asli gyan on the financial worlds. How credible are they?
अपने खून पसीने की कमाई, don't play fast and loose with that.
Okay, okay. Let's move on. Stock tips from friends. We've done this. Okay, the Indian stock market is riskier than US market. Truth or false?
No, I mean any market can be risky. I don't think Indian market is particularly risky.
Okay. Mutual funds always give better returns than fixed deposits.
Not always, but over a longer period of time, any sensibly managed scheme should give you higher returns,
Than
but with
FDs.
higher risk.
Okay, but with higher risk. Okay.
Yes.
The higher the risk, the higher the return.
Not always. The only thing certain with higher risk is higher risk of losses, not higher returns.
No higher returns. Okay. Real estate is the safest investment at this point of time in India.
Not at all. I mean, real estate for one thing is very illiquid. So you can't even get out when you want to. And even long-term returns, if you look at an all India index, have not been great. You can always look at one pocket that my uncle bought this place in Gurgaon or Greater Noida and this is what happened. But that is not the whole market.
Okay. Crypto is the future of investing?
No. I mean, you can have a very small allocation, but this is definitely not something you'll have a big allocation.
You need a lot of money to start your investing journey.
Not at all.
A higher stock price means a better company.
No.
I have also been believing this so far. But anyway, past performance guarantees future returns.
I think this every day you hear in the mutual fund advertisements.
Investments are subject to market risk.
Past performance is not an indicator of future
Okay.
returns.
More trades means more profits.
Not at all.
You should always buy when the market is down.
In general, but I mean, how do you decide what's the down and the up? But yes, I mean, it's better than buying when it is already up a lot, usually.
Debt is always bad for a company?
Not up to a point.
Okay. Financial advisors always know better than retail investors.
If they are telling you the truth, it's the agency problem that whether they're looking at their benefit or your benefit.
Okay, that brings me
that's
to the
question.
next question. DIY investing or funds management companies?
Mostly fund management companies, I would say.
How early should, as a young investor, should start that?
As soon as you can, as soon as you start working at least.
Okay. The stock market is like gambling.
Not if you do it sensibly. If you are doing this day trading and FNO trading, then yes.
And the last one is you should always sell when a stock drops.
You should have a stop loss. So it's not like it drops 10% and you sell. So, but you must have a stop loss, which is usually maybe 25% or thereabouts.
All right, this brings us to the end of the entire conversation. I'll just give a quick outro, okay? Well, that was truly insightful. If you've been largely hesitant about investing, now's the time for you to take charge of your financial future. Devina's book, Money, Myths and Mantra, is selling like hotcakes, and trust me, folks, when I went to buy the book from the store this morning, it was out of stock. So quickly go grab your copy on Amazon or look out for it in the nearest bookstore. And don't forget to hit the subscribe button. Share this with your friends who need financial clarity. And if you have more questions, please put it up in the comment section below. We'll try and reach out to you as much as we can. But until next time, invest wisely and stay smart. Thank you so much. Thank you so much, Devina ji.
Thank